Hey, welcome to another week of the Money Multiplier, how to become your own banker training. So who is this for tonight? So this is for anybody that wants to learn how to become their own bank, how to not work any harder, not work any longer, not take on any more risk, but be able to grow your wealth very safely in a guaranteed manner. This is a strategy that's been used for over 200 years that I'm teaching you. I've been personally using it for about 3 years now. And my mentors, I'll introduce you to here shortly, have been doing it for a lot longer than I have. And so anybody that is looking for a place to flow their money, to take advantage of things that the wealthy do, things that the banks do. Again, the strategy has been used for a very long time. It's very easy once you understand it. So the beginning part is going to be a little bit of mindset and understanding some of the psychology behind what we do. And then the second half will be application and actually teaching you how to use this system. So I'm not only going to introduce you to the infinite banking concept, but I'm going to actually start teaching you exactly how it works and what you can start doing right away with it yourselves for you and your family's financial future. So with that being said, I'll put this up on the screen here in just a minute as well, but this is my cell phone and my email address if anybody needs that. And I'll show you a way that you guys can contact me as well after I'm done here tonight. So we're going to go for about an hour or so. So we are going to talk a lot about money and opportunity. At the end of the day, that's what this is all about, is your money and the opportunity that you have, not only right now with learning this concept, but a lot of opportunity that's going to be presenting itself over the next couple of years as this market that we've been in, this bull run we've been in since 2008, after the 2008 crash. It's just been gangbusters, just going crazy for the last 12 years or so. So we're starting to see some changes right now. Inflation's going through the roof, spending's going through the roof. The national debt is through the roof, and a lot of stuff happening. We've had long-term, short-term debt cycles and curves that are all starting to combine and collide right now, for lack of a better word. And so we're expecting a lot of changes. We're expecting a lot of pullbacks in the stock market. We're expecting the real estate market to cool off and probably start to pull back. And when all of this happens and all these changes start to occur, it's going to create a lot of opportunity for us. Now, we spend a lot of time talking about the specifics of what's going on our other webinars. So tomorrow, if you want to join us, we do 3 webinars tomorrow. I do another one on Thursday. We do one every single Monday. So in a second here, I'm going to give you a link where you can put in your information. I'll send you over the schedule for all the other webinars that we do. So make sure you register for those. You hop on the live streams, you listen to the podcast, because it's very, very important. But everything that we do, whether you own a business, whether you're investing in real estate, whether you're doing private money lending, whether you're brand new to financial education and how to take back control of your money, if you're brand new, no matter which situation you're in, this financial journey that you're on right now, it starts with this concept I'm teaching here tonight, the infinite banking concept, how to become your own banker and control every aspect of the banking functions in your life and create that perpetual tailwind of uninterrupted compounding interest with all of your money. So it all starts here tonight, and then it rolls into everything else that we teach through our other webinars, podcasts, and trainings. So make sure you join us for those and what we teach through Money School. Very, very important stuff. So a couple of people I want to introduce you to real fast. So this right here is Brent Kessler. Brent Kessler is the owner, founder, and broker of the Money Multiplier. So go to themoneymultiplier.com, check that out. Brent is an unbelievable guy. I've never seen somebody care more for people in general and really, really care about what he does. And Brent's taught me a lot about this concept, and Brent's taught me a lot just about business in general and the way he approaches things. And I absolutely love the guy. And if you haven't met him yet, you will at one of our events. He's always out and about and mingling at different masterminds and speaking at RIAs, and just an incredible guy. So check out Brent Kessler if you haven't met him yet. And if you're here tonight, you probably know Chris Noggle. So Chris Noggle is my friend, business partner, associate, and basically the guy that, we do all this together. So Chris, like I said, if you're not super familiar with Chris, or if you haven't met him yet either, you guys definitely will. And very, very hard worker. Chris is out in Salt Lake City right now, I'm creating a bunch of new content and trainings and videos in a professional studio. And Chris does a great job of putting out trainings. And so check out the YouTube channel at the Chris Naugle. Actually, 2 YouTube channels. Write this down. I'm going to give you guys some homework tonight. So this is number 1. Write this down. Go subscribe and ring the bell on these 2 YouTube channels, at the Chris Naugle and at Money School TV. At the Chris Naugle and at Money School TV. Those are 2 YouTube channels you aren't going to want to miss. When I first met Chris, he introduced me to this quote right here by Will Rogers. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. And like I said a second ago, I'm going to open up here tonight with a little bit of psychology and mindset. And this quote right here really boils it all down to one thing. The problem in America isn't so much what people don't know, it's what people think they know that it just ain't so. So keep that quote in mind as we go here tonight, and we'll refer back to it at the end. And I guarantee you're going to say, you know what? Something I learned here tonight is something that I always thought was the other way, and now I know it to be different. And I guarantee you that you will say that by the end of this here tonight. So when we start looking at success and we start looking at money and opportunity, something that we found and we studied and we see time and time again is if you take a group of 100 people, you're always going to have about 5% of those people that are action takers, that are the ones that are making things happen for themselves, that are creating success. They're not sitting back. They're not waiting. They're not doing and following the herd and doing what everybody else tells them to do. They're the ones that are making things happen. And it coincides perfectly with my experience working with people over the last decade and a half of my life and studying stuff like this. So as one example, the Social Security Administration came out with this statistic a few years back. And the Social Security Administration said, if you take 100 people at retirement age, only 5% of them will be able to retire in a lifestyle and way that they want to. Meaning 95% of Americans in the richest country the world has ever known, with more opportunity than the world has ever known, 95% of people aren't even able to retire after working their entire lives, retire in a lifestyle and means that they want to. The system's broken. The way of thinking is broken, plain and simple. Now, I was a financial advisor out of college. I was fully licensed, Series 7, Series 66, life, health, variable annuity, went through all the trainings. I worked with Ameriprise Financial. At the time, it was American Express Financial Advisors, and they had just transitioned into what is today known as Ameriprise Financial. And at Ameriprise, my job was to meet with clients and talk to them about their hopes and dreams, and talk to them about, what retirement looks like for them, and build up, this beautiful picture of what their life was going to look like at retirement. And then my job as a financial advisor was to crush those hopes and dreams and bring them back to reality. And what I mean by that is, for most people, and with my experience and what the Social Security Administration lines up, about 95% of people, they have this idea of how they're going to be able to retire. And then when you actually look at how it's actually going to work, it doesn't. And so I would have to bring them back to reality and say, okay, if you want to retire at age 62, then you're going to have to save a lot more money right now, meaning you're going to have to spend less, meaning you're going to have to drastically change your lifestyle right now to be able to have the lifestyle and retirement that you want. It's either or. Or if you don't want to save more, then we're going to have to take on a bunch more risk, because the only way to grow your money to have you achieve the goals that you want is to be able to have more reward in your investments, which means taking on more risk. This is the traditional way of thinking about investing, right? Or if you don't want to take on more risk and you don't want to save more and change your lifestyle now, well, then your retirement's going to look different. You're going to have to push back retirement from age 62. You're going to need another 5 years if everything goes right. Or instead of going on 3 or 4 trips a year, or buying that second home, or going on, being able to, travel the way that you want to, you're going to have to you scale that back. So you're going to only be able to go on 2 trips, or you're not going to have that second home, or you can't go on those cruises that you wanted to go on, or whatever the case is. So it was giving up something to achieve something else, but there was no way to be able to achieve those goals without that having happened. So it was kind of like a bummer, right? It was like, oh, like, do I want to do this? And then, so what happened with me, at least, is I was invited to a real estate seminar where this guy started talking about entrepreneurship, and he started talking about real estate investing, and he started talking about controlling your investments and understanding how to compound your money and grow your money in ways that the wealthy do. And this stuff started to comprehend with me. And I started to think and relate it back to what I was doing as a financial advisor. And I started to think to myself, well, this doesn't seem that hard. I was never taught it before, but I was never taught the difference in stocks and bonds in college either. Like, I was self-taught when it came to studying for my Series 7 and learning how to become a financial advisor. So I figured if I could do that, I could learn how to be a real estate investor, and I could learn how to start a business, and I could learn how to become an entrepreneur. And that's exactly what I did as I set out on that path. And after a couple of years of doing things for myself, I decided to, and still working as an advisor, I decided to let all my financial licenses go and say, you know what, from this point forward, I'm going to do what I want to do in life, and I'm going to control my destiny. And I'm going to do that through real estate investing. I'm going to do that through starting and building businesses. And that's what I've done over the last 15 years. So I've owned several businesses over the years. I've owned a lot of real estate over the years. Today, I still actively am involved in many real estate projects and deals. I do a lot on the private lending side through the Private Money Club these days. But ever since now, has it always been roses and rainbows? No. I failed, but I've learned from those experiences. And that's what I've been able to do, is share that experience and share those learning curves and share those, the ups and downs with other people, and continue to learn and continue to surround myself with very successful people. And over the years, I've learned that not only do I love controlling my own future and being an entrepreneur and being a real estate investor and having that control over my life, but I've also realized that I really love working with others. I really love coaching. I really love teaching. I love mentoring. I love training. I love speaking. I travel all over the country now on stages, and I'll speak in front of groups of 100 people, 200 people, 300 people in person. These webinars are not nearly as fun as live and in-person events, but guess what? I can sit back in the comfort of my own home right now in South Florida, and I can reach, there's 50 people on this thing right now live. And I don't know how many more people will watch it on YouTube in the recorded version and on my Facebook channel and everything else. So I don't have to travel and leave my family. I can sit back and I can do this from the comfort of my own home, and I can spread this message. So I absolutely love it. I mean, that's what my day consisted of today, was being on Zooms, being on webinars, talking on phones to my clients, talking about infinite banking, talking about real estate investing. I took my son at noon to meet his new teacher. He starts first grade tomorrow. Then I hopped on a bunch more phone calls, had a bunch more meetings. I went for a 4-mile run just now, jumped in the swimming pool, combed my hair sideways, and now I'm talking to you guys right now. So using technology, it's a beautiful thing. Being able to travel and meet people in person and have the energy of a room is a beautiful thing. But this is what my life is now. This is what I love to do. So that's why I'm here right now. And I'll talk more about myself. But again, that's who I am. This is my son, my wife. I live down here in South Florida, like I mentioned, in the Jupiter, Florida area. This is the Jupiter Lighthouse back behind me in the picture. But this is what I've been able to accomplish over the last several years. And this is what I'm going to be sharing with you guys here tonight. So just wanted to kind of bring that together so you understand who I am. I don't want to, harp on anything else personally, because this is all about you tonight. But if you do have questions for me, about me, what I've done in the past, I'm an open book. So I'm happy to share with you when we hop on a one-on-one phone call. We'll definitely do that. So with that being said, and we look at 5 out of 100 people being financially secure at retirement age, why is that? Why aren't more people successful? And over my experience, I've really found it's really these 6 things right here. It's a handful of reasons why this happens to people. The top 3, taxes, inflation, and volatility. I don't think I really need to hit on these right now. I think if you're on this right now, you understand why these are wealth killers. Taxes, what do taxes seem to always do? They always seem to go up and up and up, right? Even right now with like this new Inflation Reduction Act that just was signed into law and passed by the Senate and the House and everybody. First off, don't even get me started. Join us tomorrow if you want to hear my thoughts on this Inflation Reduction Act. Join me tomorrow at 9:30 a.m. for the WTF Happened live stream podcast. But it's not going to help inflation. Don't let them fool you by the name of that thing. It's not going to tax people. Yes, it is. All of the tax institutes and research agencies are saying even the middle class are going to see an increase in taxes. And what is inflation at the end of the day anyways? It's a hidden tax on the middle class. So that's absurd. But taxes go up and up and up and up all the time. And volatility, I mean, that's up and down in the markets. Yeah, the stock market over time always goes up. But guess what? What if you're at retirement age? The stock market's at an all-time high like it is right now. We've seen a 20% pullback this year alone. Most people's 401ks have seen like a 30% reduction. A lot of people's 20 to 30%. And that's going to continue to drop. And if you don't think it is, then good luck to you, because we're going to see crazy volatility in the next year and 3 years. So if you need the money, it's fine and dandy that it's been going up over history. But if you need the money right down and your 401k is down 30%, meaning 30% of your wealth that you're planning on using in retirement is now gone. So what do you do? So those three right there are wealth killers. And the three drivers why 95% of people cannot retire. Now, there's so many little easy strategies that we can do. Start a business that will help tons with taxes. Take advantage of self-directing your retirement funds to eliminate volatility and eliminate taxes. Put your money in guaranteed vehicles like I'm teaching you here tonight to eliminate volatility and taxes. Inflation is keep our money moving so it's making more money where inflation doesn't matter to us. So these are little things I can teach you starting right here tonight to eliminate those three. Now, the bottom three are up to you. So this is where mindset really comes into play. This is where psychology really comes into play. Because if you've been told to do something your entire life, invest in a 401k, do what we tell you to do, invest in the stock market for the long term, all this stuff we're told always to do. Well, guess what? If you continue to follow that status quo and you can't break away from it because you're scared, because fear is creeping in, because you say, well, I don't want to do it because it's the way it's always been done. So why would I break away from it? Well, then good luck to you. You're going to have to make that decision on your own that you're going to break away. So don't let fear stop you. Fear is very easily overcome with education and support. And that's why we do 6 live webinars every single week. That's why I'm on the phone all day, every single day with my clients. Because if I can teach you how to do this and I can hold your hand through the process, it'll eliminate any fear that is broken into your life. So we're going to eliminate that fear. We're going to break away from the 95. You're going to become the 5%. And then life. Life is the variable in there, right? Life is the wild card because you never know what life's going to throw at you. You never know if all of a sudden you go through a divorce, all of a sudden somebody in your life dies, all of a sudden COVID hits and the country shuts down, or you lose your job, or your boss was a scumbag and stole all the money from the company and you're left with nothing, or whatever the case is, right? Life shit happens. Who said that? Forrest Gump, right? I love Forrest Gump. Shit happens. So that's life. But guess what? If we prepare for the worst, plan for the worst, then guess what? We're good to go. Because then when life throws us those curveballs, when shit happens in life, it doesn't matter because we have prepared for it. And no matter what happens, we can overcome it. So stop letting these things become excuses. These are no longer excuses. These are no longer excuses. This is stuff that we're going to overcome and we're going to put in our rearview mirror starting right now today. Are you guys with me? Is that all right with everybody so far? All right, so homework, more homework. Number 2, write this down. The backwards bicycle. So when we hop off here tonight, go on the YouTube channel, go to YouTube and type in the backwards bicycle. It's got millions of views. It's like an 8-minute video. But this young guy, what he did is he took a bicycle and he simply reversed the way that the handlebars work. So you rode a bike your entire life. You know, once you learn how to ride a bike, you'll never forget, right? So you hop on a bike and you start going, you get a turn, and your brain tells you to turn the handlebars one way and the bike's going to go that way. Well, by reversing that one simple function, guess what? I promise and guarantee you, and I will bet you $100 bill right now that you can't ride that bike anymore. By simply changing the way that the handlebars operate, you cannot ride that bike anymore because of the psychology and the mindset and the way that our minds work. Now, I'll let him explain that to you in the video. It's really fascinating. So go watch that video. But it goes back to what I was saying a second ago. We're programmed our entire lives to think one way. Sometimes it's hard to break away from that. So make sure you go watch that video. That was homework number 2, backwards bicycle. And by the way, if you're watching this on Facebook right now, I'm not on Facebook monitoring it. We're on a Zoom. So I'm watching the Zoom questions and I'm watching the Zoom chat. So if you're on Facebook, I'll come back later and I'll comment on Facebook. So put your questions in the Facebook chat, but just know that I'm not watching it right now live. And I'll come back to that in just a second. And if you're on Facebook, come over to our Zoom and join us on Zoom. And that way you can interact with us as we go. So Jeff said muscle memory gets in the way. I actually wrote one. Yeah, Jeff, it's really fascinating how that works and what that looks like. All right, so a little bit more on mindset. Very, very important here. So a few books I want to recommend. So first off, Robert Kiyosaki, anything by Robert Kiyosaki. Rich Dad, Poor Dad was one of the books that changed my life. Not only did I read Rich Dad, Poor Dad a lot of times, I was able to start teaching it. So I actually had an opportunity, because I was doing so well, to go teach with the Rich Dad, Poor Dad organization and Robert Kiyosaki. So love the guy, love everything he did. He's got a little crazy these days, but that's how some of these wealthy entrepreneur type characters are. You know, their minds go so fast that what they say can be a little crazy, but those books are really, really, really powerful. So check those out if you've never read them before. This book right here, though, Second Chance, that Robert Kiyosaki wrote, this book is all about the concept that I'm teaching you right now tonight. Tony Robbins. Any Tony Robbins fans? So Tony Robbins wrote all about money, wrote all about this concept in his book, Money, Master the Game. Another really good book when it comes to mindset and thinking like the wealthy and successful thing. R. Nelson Nash. Write that down right now. R. Nelson Nash. R. Nelson Nash is known as the godfather of the infinite banking concept. See, what I'm teaching you here tonight has been used for over 200 years. It's been used by some of the legacy families in this country, some of the most wealthy and successful families to ever walk the earth have used the concept I'm teaching you. R. Nelson Nash brought it to the limelight and brought it to where anybody can use this concept. And unfortunately, R. Nelson Nash passed away a couple of years ago, but his institute, the Infinite Banking Institute, and what he taught lives on to this day. And if you want to talk about legacy, and if you want to be one of those people that's like, I want to create a legacy for myself, that guy can be a serious mentor for you, because his legacy lives on and it will live on forever. So becoming your own banker is kind of like our Bible when it comes to the infinite banking concept. So go buy that book. Actually, we sell those. If you go to the moneymultiplier.com, you can buy a copy of it right from us on the website. 2 more books: Mapping Out the Millionaire Mystery, that Brent and Chris wrote, and then the Private Money Guide, all about private money lending, what we do at the Private Money Club, and why it's so important to keep your money moving. Now, these bottom 2 books right here, we will give you a free copy of them, a physical copy, if you just pay shipping. But how many of you would like free copies of both these books digitally? I'll email you digital copies tonight. Would anybody like these 2 books right here? Just for being on this webinar right now. All right, so if you want a copy of one of those books, here's what you got to do. You got to go to this website right here. Actually, I'll put it in the chat box. It's moneyschoolrei.com/Snagy. That's me, Snagy, S-N-A-G-Y. So go there, put in your name, email, and phone number, and it'll automatically email you a copy of both books. It will also email you a copy of the webinar schedule. So if you want to join me for the webinars tomorrow, Thursday, or next Monday, it'll email you a schedule of those webinars. So that way you can continue your financial education and your mindset. So go there. And then if anybody wants to book a call with me, Like I said, it's all I do all day, every day is webinars, podcasts, and calls with my clients. If anybody wants to schedule a call to talk more about this concept, if it's right for you to get it set up, talk about your retirement funds, talk about investing, opportunity, entrepreneurship, it'll also give you an opportunity to schedule a call on my calendar right by visiting that link right there. So shoot over there, get that going. Here's what we need to understand. First off, we need to understand spread, and we need to understand two terms, simple interest and compounding interest. So a lot of what we do is built around spreads and compounding interest. So this is just a quick little simple example of compounding interest. So what do you guys think? Look at the screen right here. Can you make money earning 4% while paying 6%? What do you think? Yes or no in the chat box, real quick. Can you make money earning 4% while paying 6%? So let's say you want to buy a car, $25,000. You've been saving up in your savings account at the bank. You go down to the bank and you say, hey, Mr. Banker, I am going to go buy a new car. I've been saving up for it. I got $25,000 in my savings account. I want to withdraw that $25,000 so I can go buy my car. So the teller at the bank says, okay, 1 minute, please. Be right back. And then what happens? If you've taken cash out of a bank lately, you guys know exactly what happens. Some fancy banker with a suit on comes out, says, hey, how you doing? My name is Mr. Banker. And they shake your hand. And they got a name tag on it. That name tag says, what does that name tag say? It says vice president, right? Everybody at the bank is a vice president. And if you don't know, next time you go to the bank, look, they're all vice presidents. And I'll tell you why in just a second. But that vice president comes out. See, I'm vice president myself. Can you guys see that? But I'm vice president of cash flow for my own bank. Nonetheless, I'll tell you why they're all vice presidents in just a second. So that vice president comes out and he says to you, hey, guess what? I understand you want to buy a car. Awesome. Congratulations. You've been saving your money, $25,000. However, I'm going to make you an offer. Hear me out here. What we're going to do is I'm going to offer you to keep your money in your savings account, and I'm going to offer you a 4% return on your money in that savings account. And then what we're going to do is we're going to use your money as collateral in the bank account, and I'm going to give you a loan for $25,000 so you can go buy that car. So you say, okay, well, that sounds pretty cool because 4% is a pretty good return on a savings account where my money's guaranteed. So I'll go ahead and do that. So what's the loan going to cost me? And the banker says, well, the loan is only going to cost you 6% interest. And you say to that banker, you look him right in the eye and you say, listen here, Mr. Banker, when I walked in here, I knew you were going to try and do some shady stuff to me. And that's why when I took a little lollipop out of your little bucket there, you know, all banks have a bucket with the lollipops in them, right? And what is the name of those lollipops that is in that bucket? What is the name that's on lollipops in every bank, in every bucket around the whole country? That lollipop's name is Dum Dums, right? Those lollipops are Dum Dums. So you pull that Dum Dum up and you say, I know you think I'm a Dum Dum and you're the fancy banker with the suit on, the vice president, and you think I'm a Dum Dum, but there is no way that I'm going to pay you 6% while you're only giving me 4%. And then the banker says to you, no. Hold on. You got it all wrong. Let me show you what I'm talking about. Now, if you have a compound calculator, you guys can take it out and you can do the math right now, but I already did the math for you. So here's how it plays out. $25,000 at 6% over 60 months, like a normal car note is, 5 years, is going to be a monthly payment of $483.32 a month. At the end of that 5 years, that $25,000 will now be $29,000. However, over here, that $25,000 at 4% over the same 60 months grows to be just over $30,500 because the $25,000 at 6%, the loan was decreasing as that $483 a month was paid into it. Even though you're paying a higher interest rate, the principal amount is being reduced every time you make a monthly payment. So the amount, the simple interest, the 6% that you're paying on a depreciating loan over time will be less and less and less. So at the end of that 5 years, it's only $29,000. In contrast, our $25,000 over here, the same 5 years, but because it's at a smaller interest rate of 4%, because it's compounding each year and it increases every single year, the amount that's compounding is more and more each year. At the end of the same 5 years, you now have over $30,500. You actually just made over $1,500 while earning 4% and paying 6%. Plain and simple. So this is just math. But again, a lot of what we do with this concept works off of simple versus compounding interest and works off of spreads. So I just wanted to lay out from the beginning that you're going to have to change your mindset and have an open mind as I go here tonight to fully understand this concept. Fair enough? You guys okay with me so far? All right, let's roll. What is the money multiplier method? Well, the money multiplier method breaks down into 3 parts: the machine, the marathon, and the millionaire. And I'm going to break these down for you in just a second. The machine is the vehicle we use to warehouse our wealth. The machine is where we're going to run our money through. The machine is going to be our new bank. The marathon is the compounding interest aspect of all of this, meaning you will become a millionaire. This the third part, the millionaire, will happen if you use the machine, the concept, and you follow the marathon properly. Okay? Plain and simple. Then the millionaire will occur. But it is a long-term play, okay? You're going to start taking advantage of it immediately. You're going to start using it right away. You're not waiting. You're controlling everything immediately, but it's going to take a few years for this thing to start kicking in. But then once it starts, guess what? It never stops for the rest of your life. Uninterrupted compounding interest. And it's a beautiful thing. So that's what we're going to talk about. So what is this machine? What is this vehicle that we're warehousing our wealth in? Well, this machine is a dividend-paying whole life insurance policy from a mutually owned life insurance company. That's it. Now, a couple things real fast. Let me be very, very clear about this. Number one, this is not a whole life policy that's off the shelf. This is not a whole life policy that you call your brother-in-law, your best friend from high school or college, your neighbor, someone in your networking group, whatever. We all know somebody that sells life insurance, right? This is not something you go to legacygenius.com. This is not something you call the insurance company and get. This is a specially designed and engineered whole life insurance policy designed specifically for banking and for the infinite banking concept. This specially designed and engineered whole life policy is what we do. This is what myself and my team do at the Money Multiplier all day, every day. We don't do any kind of other kind of life insurance. If you want an IUL, don't get me started. No. IUL, Index Universal Life. If you want a term policy, I'm not your guy. If you want a whole life off the shelf, I'm not your guy. This is all me and my team do all day, every day. Okay. I want to be very clear about that. Number two, why do we use a whole life insurance policy from a mutually owned insurance company that pays dividends to do this? Because this is what the United States government and the IRS allow us to use as the machine and the vehicle to create the perpetual tailwind, to create uninterrupted compounding, guaranteed tax-free growth on all of our money from this point forward. This is what the IRS allow us to do. Why do they allow us to use this machine to do this? It's because it's what the wealthy do and it's what the banks do. And I'm going to show you that in just a second, okay? But I wanted to be very clear what this is, who does it for you, we do, and why we use this. There is not a better vehicle out there to warehouse our wealth that gives us all of these benefits, all of these features, and all being able to use it this way. There's nothing else out there that exists. That's why we use it, okay? Plain and simple. All right. And if you want to start checking out, more homework for you, write this down. If you want to start checking out what I mean by this, go look up BOLI, BOLI, bank-owned life insurance. In fact, do you know who the number one purchasers are of whole life insurance in this country? Banks. I mentioned before, why is everybody at the bank a vice president? It's because by making that employee a vice president, the bank now has an insurable interest on that individual, and it allows the bank to now open a whole life policy on that individual. The banks use this every single day. The banks are the largest purchasers of whole life insurance in the country. In fact, do you know what the banks do with all of the money that they make? Do you know what the banks do with all of their money? Their M1 money supply is invested primarily in two places. Do you know what those are? Number one, whole life insurance. Number two, real estate. Do you think there's a reason why myself, why Chris, why Brent, why we teach, why we do whole life insurance in real estate? Because it makes sense. All right, we'll talk more about that as we go. So who else uses this concept? Jim Harbaugh. Any football fans? Jim Harbaugh is one of the most well-known college football coaches, the Michigan Wolverines head football coach. But check this out. This was from 2016. Cash value life insurance makes Harbaugh college football's top paid coach. This type of deferred compensation alternative appeals to talented leaders and executives. The arrangement makes Harbaugh the highest paid college football coach in the country, according to Sports Illustrated and other news outlets. How about Joe Biden? Biden also holds 4 checking accounts, 2 of which he shares with his wife. In addition, he holds 6 life insurance policies with Mass Mutual. Mass Mutual is one of the mutually owned insurance companies that we do business with. Why does he have these policies? Because it's private, because he can use the money within the policy without reporting it to anybody, and because it's protected. And that's exactly why we do also. How about Walt Disney? Walt Disney failed in his pursuit of traditional means of financing to build what will later become Disney World. Walt decided to provide his own financing. A large part came by collaterally borrowing from his cash value life insurance policies. Doris Christopher of the Pampered Chef used her policies to fund what later became a $1.5 billion company that Warren Buffett purchased with over 12 million customers. Ray Kroc of McDonald's used 2 cash value life insurance policies to help cover salaries of key employees. And the list goes on and on and on, guys. Some of the wealthiest families, the JPs, Morgans, Chases, Vanderbilts, Rockefellers, the list goes on and on and on and on. So not only the banks use this, but the ultra wealthy, the ultra successful. So if they are doing it, do you see why maybe you should be implementing this into your life? Absolutely, right? And that's why we're here tonight. So let me show you what the banks are doing so we can start mimicking the banks. Now, I mentioned before about a spread. So this is how banks make money off of a spread. This is one of the ways that the banks make money off of a spread. This is one of the ways that I make money off of a spread. And this is why we're going to start becoming our own bank. Stop letting the banks become rich and let's become rich ourselves. Are you okay with that? And Todd said on here, banks have over $90 billion in bank-owned life insurance. And I think it's even higher than that now, Todd. But yeah, it's a wild amount. So, all right. So here's how it works. You have money. You go to the bank now and you deposit that money in a checking account, a savings account, some other kind of account that they have there, right? Sits in there and maybe they pay you a percent in a savings account. Maybe it's a magic bank and they pay you 4% in a savings account. But nonetheless, that's what you make. Then the bank, you go down to the bank to get a mortgage. Let's say the mortgage, the bank charges you 7% for a mortgage. I know it's more right now, like 5%. And I know this is more like 1 or 2%, but the spread is still going to be the same, right? Then you take that loan, you buy the house, you give the money to the sellers. The sellers take that money. What do? They put it right back in the bank. Then you need a car note, 8%, give it to the car dealer. Then you want to remodel your home, give it to the contractor. And the cycle just goes on and on and on. So what did the bank just do? The bank made 3% spread there. They're paying 4% to you, they're making 7, they're making a 3% spread. They make a 4% spread off that car note. They make a 5% spread off that home remodel loan. And they make a 8% spread off of that debt consolidation loan. So the bank just made 20% off of your money, right? The bank actually just made 500% off your money. Because if they're paying you 4% and they're making 20%, that's 5 times more they're making off of your money than what they're paying you, or 500%. In fact, here's more homework for you. Go to BauerFinancial.com. Bauer Financial is an organization that researches banks, and they report on the banks. And BauerFinancial.com tells us that banks make between 400 and 1,300% off of money that you leave sitting there. So let me ask you this question. Why are you making the banks rich? If you could be your own bank and you could be making this money, why aren't you? Has nobody introduced you to this before? Have you never understood it before? Did you think it wasn't obtainable before? Well, I'm here telling you right now, you need to start taking back these functions, taking back this money, taking back this interest that the banks are currently making. You need to take it back into your life right now, starting today, period. Don't make the banks rich. Let's make ourselves rich. You guys okay with that? So let me show you how we start doing this. So one of the things we're going to need to start doing is we need to start recapturing all of the money that we're currently giving to everybody else, recapturing that spread, recapturing that interest, recapturing the time cost of the money, all of this. So let me show you how we start recapturing this money. So if we take a dollar bill and we break out a dollar bill, on average, how every dollar that you make is spent in this country on average. On average, every dollar that somebody makes, 20 cents of that dollar goes to an automobile, whether it's payments, whether it's gas, whether it's upkeep, insurance, whatever the case is. 20 cents goes to automobiles. 30 cents of every dollar you make goes to housing. 40 cents of every dollar you make goes to everything else: travel, kids, entertainment, food, whatever the case is. Which means 10 cents of every dollar we make, 90 cents goes to everybody else. 10 cents of every dollar we make goes to us in savings. All right. So you see how that works? We earn a dollar, 90% of it goes to everybody else. And then what's left over, 10%, if we're lucky, goes into our savings. So let's start building this backwards. Let's start recapturing that money and keeping it in our financial lives. And let's increase our savings without working any harder, without working any longer, without taking on any more risk. Let me show you how we do this. So if we start with the savings, very important, pay yourself first. Okay. You're important. Pay yourself first. So let's start with the savings. We start with that 10 cents of every dollar. We immediately put it into the savings. Okay. And then we're going to start spending. So let's look at the automobile. On average, 5 cents of every 20 cents spent on automobiles goes to interest. So 5 cents of every 20 cents goes to interest. So let's go ahead, instead of giving that interest to the bank, Ally Financial, BMW, Toyota, Honda, whatever the case is, instead of giving that 5 cents of every 20 cents to someone else, let's give that back to our bank. So we're going to take that 5 cents and we're going to put it into our savings, our bank. Okay. By doing that one thing right there, what did we just accomplish? We just increased our annual savings by 50 cents. By keeping the interest in our bank instead of somebody else's bank, we just increased our annual savings by 50 cents, 50%. Because if we were saving 10 cents before and we're adding 5 cents more to that, that's a 50% increase, right? So let's start there. What if we do it with other things? How about housing? Did you know that on average, 25 cents of every 30 cents spent on housing goes to interest? How can that be? How can 25 cents of every 30 cents spent on housing go to interest? How can that be? Well, think about it. Did you know on average, every 7 years, a homeowner either moves or refinances their loan? Did you also know that because of the way that amortized loans are set up, that a 30-year fixed amortized loan, a mortgage that you get from a bank, over 90% of the interest paid on that 30-year loan is paid, you guessed it, in the first 7 years. So if people are moving and refinancing or they're moving and starting a new mortgage, there's a reason a due on sale clause is in every single mortgage these days. So if you're moving or refinancing on average every 7 years and over 90% of the interest is paid in the first 7 years, who wins? The banks do. You see why they do this stuff? And if you're renting, 100% of it's going to somebody else, right? So what we're going to do is let's recapture that interest. Instead of giving it to everybody, instead of giving it to the banks, let's take that interest and keep it in our financial life. Are you okay with that? And then on average, out of the 40 cents on everything else, 5 cents is spent on interest. So let's go ahead and while we're at it, just recapture that 5 cents as well. So we didn't do anything else. Just by paying ourselves first, flowing our money into our bank, and then using our bank for these loans, we now are paying ourselves interest instead of other people's banks. It just increased our savings from 10 cents a year to almost half of everything that we earn. Are you okay with that? So we're going to start recapturing that money into our banks, period. So how would you like to get all the money back for every car you'll ever buy, drive, and own? Check this out. This is really cool. All right. So before I show you exactly how to do that, let me show you how these policies work. So let's take a quick look under the hood of a whole life insurance policy. So over on the right here is what we call a illustration. And the illustration is a projection of what your policy is going to do over time. So you'll see right here, this is the policy year, the first year of the policy, and so on. This is the age of the individual. So this was a 26-year-old male. He wanted to put in $10,000 a year into the policy, which I'll talk about in a second. This was the car purchase and the recapture of the money that I'll show you in just a second. Over here is what we call the cash value. The cash value of the money multiplier policy, of the whole life policy, is the amount that's available for loans as the premium deposits go into it. So we'll talk more about that in just a second as well. And then the death benefit is the amount of money that's going to be paid out to your beneficiaries tax-free when you pass away, when you graduate, when you move on. Okay. So this is what we call an illustration. And we'll talk more about this as we get going here tonight. So a few things to point out on this. First off, you'll see how we have deposits right here. These are actually premiums. So these are the premiums that go into the policy that make up the whole life policy. However, if you think of a premium, a car payment, an insurance premium, it's a negative mindset, right? Because nobody wants to pay bills, and we associate premiums with bills. So what we want to do is we want to what we want to do is start changing our mindset. I mentioned that earlier. So instead of thinking about the premiums as bills, as a negative premium, we want to start looking at them just as deposits. Because at the end of the day, where is this money going? Where are these premiums going? They're going into our new bank, into our new policy. So we want to start thinking of these as deposits. Are you okay with that? So from this point forward, I want you to commit to you referring to these as deposits. And you're going to see that in everything that we talk about. Age. You'll notice this is a 26-year-old. I started a policy for my son when he was 20, when he was 5 years old last year. So we start policies for people in their 70s. And if you're older, in your 80s, or for some reason you can't qualify for a whole life policy, don't worry. We do have solutions for that as well. What we can do is we can actually start a policy on somebody else's life. And you can still own it, control it, use it for banking. It would just, the death benefit would be on somebody else's life. So we have plenty of solutions for that as well. again, I mentioned the death benefit a second ago. So that is something that's on the policy. However, we don't do this for death benefit. We build these for banking purposes. So we kind of build them backwards. So a typical whole life, you would say, hey, I want $1 million of insurance, of death benefit. What's that going to cost me? Well, we say, how much do you want to deposit into it on an annual basis? And then the death benefit, it is what it is. Okay. So when it comes to these deposits, the amount is up to you. I'll never tell you how much to put into it. As a guideline minimum, I'm going to recommend at least 10 times your age on a monthly basis. So if you're 22, $220 a month or more is a good policy. If you're 35, $350 a month or more. If you're 52, $520 a month or more is a good guideline minimum to where to start for your first policy. So that amount or more is a good guideline, but you tell me. You want to put 10,000, you want to put 20,000, you want to put 50,000, you want to put 100,000. That's completely up to you. So those premium deposits, you're going to tell me what to do. All right, let me show you how to recapture money using one of these policies. So again, this was the policy I just showed you, $10,000 a year going into it. In the third year, they wanted to buy a car. So they took a $25,000 loan from the policy. Then just like you would repay a loan from the bank, you want to recapture that money. So just like you would pay back Toyota or BMW or Honda, well, you're going to pay back your own bank. So we take the $25,000 loan and then we repay it. So at the end of the day, we put $70,000 in. We took $25,000 out. We recaptured $30,000 and we have $67,000 in our account. So think about it. We put $75,000 in. We still have $67,000 sitting in our account, and we have a car parked in the driveway worth $25,000 free and clear cash. So if I do the math here, I didn't recapture all of the money, although if I sell the car, I would have, but I didn't recapture all of the money, but I recaptured 91%. Not bad, right? But I told you a second ago, we're going to recapture all of the money. And here's the thing. This doesn't stop after 7 years. This keeps going for the rest of your life. And it's stronger and stronger and stronger every single year for the rest of your life. So watch this. The 8th year of this policy, we buy a second car. Now you're going to notice we don't put any new deposits into this policy starting in the 8th year. No new premiums. Now, realistically, in the policies we designed today, you're going to want to never stop putting money into this thing because the compounding becomes stronger and stronger every year. But for this example, just to show you how this works, even without that extra compounding and deposits going in, watch this. So we take a loan, $25,000. Again, we recapture the money. So we took 25 out, put 30,000 in, $5,000. But look what happened. Our account grew from 67,000. We only put $5,000 in it. Our account grew from 67 to $91,000. It grew by over $23,000. Now, if you ask me, my account grew by $23,000 over that time. I put $5,000 in. I have $91,000 cash available to me to use for the next purchase. And I have $25,000 car one. I have $25,000 car two parked in my driveway, completely free and clear. It seems to me like I just recaptured all the money for all my cars that I'm buying right now. You guys okay with that? So we're just going to start recapturing this. And guess what? If this works for cars, what else does it work for? But this concept does depend on 3 different rules. So let me show you those rules. Rule number 1, pay yourself first. Remember, you're important. Put those deposits into your bank on the regular. Rule number 2, always recapture the money. So just like if you take a loan from the bank and pay them back, pay yourself back. Now, let me ask you this. If you run into some trouble, let's say in year 3 of this loan, and you can't pay it back, what's going to happen? Well, if you had a loan from BMW and you stop making your car payments, they're going to send a repo guy out, and that repo guy is going to take your car away from you. Well, if you don't pay your own loan back from your own bank, what's going to happen? Well, you're the banker. You're in charge. You set the terms. So for me, I'm probably going to cut myself a break and not repo my own car, right? I'm going to wait till I get back on track, and then I'll start recapturing the money at that point. But the bottom line is you're in charge. It's your terms. So you do it however you want to, plain and simple. All right. And then rule number 3, show you the rules right now. Oh, rule number 3. Rule number 2, excuse me, pay yourself with interest. And rule number 3, recycle and recapture your money, just like I was talking about. So pay yourself with interest. All that means is if you're going to get a car loan and they're going to charge you, BMW is going to charge you 5%, well, charge yourself 5% too, because why would you not pay your own bank back interest if you're willing to pay somebody else's bank back interest? So always pay yourself with interest. And these are the rules of infinite banking. We're going to help with all this, and I'll explain that in a second. But again, if this works with cars, what else could it work for, right? All right. Now let's get into debts. So unfortunately, sometimes when people start making good money, sometimes that third-party debt starts to build up. So watch this. This was a chiropractor. This was a real client of ours that we created this plan for. And this chiropractor had $478,000 in debt, third-party debt. You could see it all listed right here. We did the math on it. If he was to pay it back as planned, it would be 19 years. He was paying almost $70,000 a year in third-party debt, $5,777 a month. So what we did is we said, okay, let us show you how you can use becoming your own bank and the infinite banking concept to pay this back a lot quicker while still building wealth for you and your family for the future. So watch this. So what we did is this chiropractor started a policy putting $25,000 a year into it. Remember, I told you, you tell me how much you want to deposit into this thing on an annual basis. And by the way, you can pay into it monthly, quarterly, biannually, or all up front each year. That's up to you how you get that $25,000 a year into it. But you tell me how much you want to put into it annually. So the chiropractor wanted to put $25,000 into his banking policy. So the first year he puts $25,000 in, he has about $15,000 available in cash value to pull out for a loan. Now you'll notice he puts 25 in and only has 15,000 available. He doesn't have all of it. It's a marathon. It takes a few years for the policy to become efficient. But what did I say before? Once it becomes efficient, once that compounding starts to kick in, it'll never stop for the rest of your life. And it just becomes stronger and stronger and stronger. And we do create policies now that have much higher cash value in year one immediately and in the early years. But in this example right here, it still works like a charm. So check this out. So what we do is we put 25 in immediately within 30 days, take the first loan for $15,000. Immediately take that $15,000, pay off the Discover, pay off the Lowe's, and pay down the Nordstrom card. Okay. What did we just do? We just eliminated these payments that we were paying to them. So what are we going to do with it now? Instead of paying Discover, instead of paying Lowe's, we're going to take that $448 a month and we're going to pay back ourselves. So instead of giving it to Discover and Lowe's Bank, we're now giving it to my own bank. So now we have $5,300 going to third-party debtors and $448 going back to myself. Now, let me teach you something real fast when it comes to banking. When you start doing infinite banking, you're going to set up what's called a segregated bank account or a separate bank account. And this separate bank account or segregated bank account is what you're going to flow all the money through. So when you take a loan, it goes into the segregated account. From the loan, it goes to pay off Discover and Lowe's. And then you're going to start recapturing that $448 a month back into the segregated bank account. Because what it's going to do is it's going to build up within the segregated bank account. So then we can use it next year or right away or whatever your map is planned out to be to pay off more debt. Okay. And you'll see this as I show you right now. So now we have 5,300 going to other people's banks and 448 going into our segregated bank account, otherwise known as our banking system. So year 2 comes around. 25,000 goes into the policy. We now have 16,500 available to take out as a loan. And we also have $5,300 in recaptured money in that segregated bank account. That's 448 a month times 12, 5,374. So we now have the cash value from the policy, the 5,300 from our segregated account, for a total of $22,000 that we can pay off debt with. So we take that money, we pay off the Nordstrom, we pay off the Wells Fargo, and we pay off the private loan, and we reduce the BMW balance. Okay. So now we have $1,900 a month going back to our banking system and $3,800 a month going to third-party debtors. Same thing. Year 3, 25 goes in. We have 25,000 to take out as a loan, 23,000 in recaptured payments, for a total of 48,000 to use to pay off debt, pay off the BMW, pay off West Marine, lower the condo. Now, let me make sure you're following so far. Here's what's happened. Quick review. We put $75,000 into the policy in the first 3 years, and we took out $55,000 from the policy to pay off debt. So if we put 75 in, we pulled 55 out. How much do we have left in our policy right now today? How much? Is it $20,000? All right. Some of you are following right now. It's not. It's $75,000. Because remember, we put this money in our policy. When we take the money out, it comes out in the form of a loan. See, what actually happens is we deposit the money in, and then the insurance company uses that policy, uses that money as collateral to give us a loan, and they lend us money from the insurance company's general account. So that allows that $75,000 to remain in our policy, compounding every single dollar of it uninterrupted for the rest of our lives, even while we're simultaneously taking the money out and using it for other things. That is the power of this concept right here. Year 4, 25 goes in, 26 available, total 44,000 from recaptured payments, $70,000, pay down the condo. Year 5, same thing, pay off the condo. Now watch this. Year 6 of his first policy, instead of $25,000, the chiropractor was only allowed to put $10,000 in. So here's how this works. When we build and we design a banking policy for you, we have to work within the IRS regulations and rules known as MEC, M-E-C. It stands for Modified Endowment Contract. See, the IRS regulates these policies through what are called the MEC rules. So when we build a policy, we max it out to the MEC limit. However, if we ever put in more money than what that policy was designed for, it could MEC the policy. And we don't want that to happen, because then it could tax the entire thing. And one of the reasons we do this is because when we put our money in the policy, all that money compounds and grows tax-free. The money comes out through loans tax-free. The death benefit is paid out tax-free. Remember, taxes is one of the 3 wealth killers. So we want to avoid taxes at all possible means. So we never want to MEC a policy. So, however, just because we can only put $10,000 into this policy, this chiropractor wanted to put more money in to start growing his banking system even larger. So here's what we do. We start additional policies. There's no rules for how many policies you can have on yourself that you qualify for. So this chiropractor started a second policy. So now his first policy, he puts $10,000 in. Of that 10 he puts in, he now has 13,000 he can pull right back out. And in the second policy, he puts 25,000 in, kind of resets it. It's in year 1 again. So now he has 15,000 he can pull back out from that first policy. So 54,000 in recaptured payments, $82,000. We pay off the house. we now have no money going to third-party debtors. We paid off all third-party debt in 6 years. He now has all of that money in the policies, compounding and growing and building wealth, tax-free for him and his family for the future. And he's completely third-party tax debt-free. Now, that $57.77 a month that he was giving to third-party debtors, what is he going to continue to do with that? Yes, he's going to continue to pay that back to his bank, recapture all that interest into his family's financial future. And now he is ready to go for whatever he wants to use that money for next. So this is what we call a debt map. So what I just showed you right there is a plan. This is what we call a debt map. And if you're in debt, we will do this for you also. So one of the things that we have at the Money Multiplier is not only am I going to help you design, create the policy, make sure it works for you, help you get approved for it and everything else. Once you have the policy, we have a mapping team. And my mapping team is going to build out your plan for using the policy. So if you want to pay off debt, we're going to do a cash flow analysis. We're going to analyze all of your debts, and we're going to create that plan just like you saw with the chiropractor, but for your situation. And this is all free of charge. I make money. We make money by bringing the insurance company business, a commission, just like any other insurance agent. Now, because I give you all the benefits and you're able to start using this thing immediately within the first 30 days and taking all that money out right away immediately through the loans and everything, I take about a 60 to 90% reduced commission compared to a normal whole life policy. But nonetheless, that's how we get paid and why we're able to do all of this for you completely free of charge. So all of the ongoing support, the mapping, the debt map, you don't pay for any of that ever. You'll never pay us a dime, okay? So I just wanted to make that very, very clear. I like to consider it a financial GPS. Where are you today? How are we using this? Where do you want to be in the future? And let's create that plan, that map for the money flow, the money movement to get you to where you want to be, plain and simple, okay? And I want to talk more about money flow and money movement in just a second, because that's how we really start building wealth and we become the millionaire. So when it comes to the millionaire, ask yourself these questions. What if you don't have any bad debt? Or what if we've already paid off all of our bad debt? What if you don't need to make any major purchases like a new car? Can you still benefit from this? Should you still become a bank? And the answer is absolutely. Because this is where the fun begins. This is where we can start building wealth, creating a legacy. So let me show you exactly how we start to do this. Wealth is created in multiple ways. So once all of that is done, once we're done with the purchases, this is where you come in. This is where financial education, this is where you as an entrepreneur, you as an investor, this is where you're going to be able to start shining. So these are ways that I create wealth. How do you create wealth? This is all stuff that we teach in money school. We teach at our 3-day trainings. We teach at our masterminds, how to invest in real estate, how to do private money lending, how to create and invest in private funds, how to do commercial real estate, how to be a business owner, trade stocks, options, crypto, do notes. That's the ultimate, right? Becoming the bank, creating mortgages. So these are all ways we can start using our policies, using our wealth to create more wealth, to get our dollars, our little green men out there conquering other dollars and making more dollars for us. And that's what this is all about. So let me show you some examples of this. When it comes to creating wealth, there's 2 laws. Number 1, you have to have your money compounding. Albert Einstein said this. Albert Einstein said compounding interest is the 8th wonder of the world. Those who understand it use it. Those who don't pay it. So how about uninterrupted compounding interest for the rest of your life? Number 2, you have to keep your money moving. Money moving is making more money. Moving, sitting still is losing money. So if we look at these 2 laws when it comes to creating and building wealth, and then we think about what these policies allow us to do, what becoming your own bank really is all about, these 2 things right here. Because these policies, becoming your own bank, allow you to do both of these. And not only allow you to do both of them, it allows you to do both of them simultaneously. because that money we put in there, every dollar compounds uninterrupted tax-free for the rest of your life. Simultaneously, you're pulling the money out and you're getting that money moving, making more money for you. So we're simultaneously doing both these things. So we start flowing more and more money through it. Can you see how this starts really growing? How it starts really making a huge effect in your life? It's very, very powerful stuff. You're not working any harder. You're not working any longer. You're not taking on any more risk. Just where that money flows first. So here's an incredible example. Let me show you. So here's a couple policies. These are illustrations. This is with Lafayette Life Insurance Company. This was a 41-year-old female real estate investor out in the state of Washington. And she just started this policy earlier this year. But check this out. So the contract premium, also known as the deposits. So she wanted to put in $50,000 a year, but she had just closed on a house and had an extra $100,000 that she didn't know what to do with. So one of the things we can do is we can do what's called a dump in the first year. So if you have a larger amount, you can dump that in the policy up front, jumpstart the compounding interest, have access to almost all of it to pull it right back out, but it gets it in there. And then just pick, however much you want to do annually moving forward. So she wanted to get $150,000 in the first year, but only wanted to do $50,000 a year moving forward. So that's what we did for her. We designed it. She puts $150,000 in. Now look at the cash value. The first year she puts $150,000 in, she has $132,000 available, over 90%. Very high cash value policies we can design for you these days. And look at this, in the third year of this thing, already positive cash on cash. She puts $50,000 in. The policy grows by over $50,000. In the 12th year of this policy, she puts $17,000 in. The policy grows by over $47,000. That's over $30,000 in growth just by putting the money in her own bank as opposed to somebody else's bank. Where else can you do that? And I'll show you an example of this exact policy using it for real estate private money lending in just a second. But here's one more example of an illustration. So this person wanted to do $500 a month. That's it, $500 a month. But they had $50,000 that they wanted to dump in also. I think the $50,000 was from a refi. Everybody has equity in their homes right now. Everybody made a bunch of money in the stock market. Get the money out of the stock market before you lose it all. A bunch of people made money in crypto. What are we doing with that? So dump that $50,000 into $500 a month. The first year, they had over $51,000 available to pull back out. Very high cash value policy. I think this was also with Lafayette Life. So here's the flow of money. Here's our policy. Here's our insurance policy, money multiplier policy. This is where the money's warehoused. We take the loan. The loan's going to be 3 to 5%. So whenever you take the money out of the policy, you're going to pay the insurance company 3 to 5% to take the money out. Like I said, it's going to go into the segregated account. And then from there, whatever you're going to use it for. In this case, I'm going to do a loan to somebody in the private money club for 12%. They're going to pay me monthly interest payments back to my segregated account. I'm going to take the spread. So if I'm making 12%, I'm paying 5%. I'm making a 7% spread. So that's 7% I'm going to keep as profit. And then the 5% gets cycled back into my policy. Make sense? So I'm operating off of the spread. And at the same time, all of my money is in there compounding and growing for me. All right, here we go. Here's an example. It's that same policy. Watch this. So the 8th year of this policy, they put $48,000 in. It grew by $66,000 for a 37% cash on cash return. You guys could do the math. If you make $18,000 and we do the math, it's a 37% return. So what we're doing is we're taking cash value out of this policy and we're doing a private money loan. So the private money loan makes me 12%. I made 37% within my policy on the money. I paid 5% to Lafayette to use this money. So at the end of the day, I made a 44% return on my money that year. So think about it. Would you rather make, if you were to take the money from your Wells Fargo account and do that same private money loan? Well, Wells Fargo, when you take the money out, is not going to pay you compounding interest. So you're going to make 12%. But she has been depositing her money into her own bank instead of Wells Fargo Bank. So when she takes the money out of her bank to do a private money loan, the same 12% private money loan, she now makes 44% money on returns on her money that year. So would you rather make 12% or 44%? Remember, we didn't do anything different, just where our money goes first. Your money has to go somewhere, right? It's got to go into somebody else's bank or it's got to go to your bank. So you tell me, what would you rather do? What kind of returns would you rather make? Would you rather continue to make the banks wealthy or do you want to become wealthy? And that's it. Plain and simple. There's nothing else to it, guys. The death benefit's tax-free. The loans never have to be repaid. I mentioned you're in control. You decide. You should repay the loans, especially in the early years doing the infinite banking concept, but later on in retirement, if you just don't want to, if you want to keep the money moving, you're in control. It's your bank. Tax-free growth policies are exempt from judgments and liens in most states. They're very private. They're very protected. We can use these things for business. So ask me on the phone call, should I do a company-owned life insurance policy? Should I do a personal policy and lend the money to my company so my company can use it? My company can get a tax deduction for the loan interest. My company continue to grow. That's what I do. So use it for business. Kids policies. I'm doing this for my son, Bryce, all day long. I'm going to show him how to buy a car with it. I'm not only going to, I'm going to show him how to use it for college expenses. I'm going to show him how to use it to start a business. And one day I'll transfer it to him where now he owns his own bank. But right now I own it. So while I own it, I'm going to use it with him. I'm going to teach him to use it. I'm going to give him a financial education. And then one day he'll have his first policy to become his own bank. And then he can start opening additional policies to grow his banking system as well. So again, these are all excuses. The wealthy know how to do it. Warren Buffett says the best, if poor people would just do what rich people do, they wouldn't be poor anymore, right? Warren Buffett has such a simple way. Warren Buffett's the one that said, it's crazy that I pay less money in taxes than my secretary does. Warren Buffett's the one that said, making money's easy. All you got to do is buy low, sell high, and don't lose money. Warren Buffett's the man. So listen to Warren Buffett, guys, and ask yourselves these two final questions. When you look at this concept, when you look at whole life used this way, when you're alive, are you better off with or without one of these? And when you die, are you and your family better off with or without one of these? And if you can answer yes, you're better off with it for either and both of these questions, then I'd love to talk with you. So what you're going to want to do is you're going to want to go to that site right there. My call calendar is on there so you can schedule a call with me. If you don't see any time that works for you, then text me, send me a text, send me an email, say, hey, Stephen, I'd love to talk. These are the days and times I have available, and I promise you I'll make it work. We will find a time we can talk about your situation so I can help you get started with the infinite banking concept and becoming your own bank. So with that said, that's all the time I have right now. If you have any questions, please put them in the Q&A. I'll answer them. If you're on Facebook, again, I'm not monitoring. I'm on the Zoom right now. So if you're on Facebook watching this, put your questions in the comments on the Facebook thing, and I'll come on Facebook later and I'll answer all of your questions. But with that being said, I look forward to working with all of you, talking with you on the phone, and helping you guys become your own banks. Have a great day. I'll talk with you soon. Thank you guys so much.